Welcome back to the Deep Dive. Today, we are going to get into something, well, something I think is one of the most critical yet somehow overlooked layers of corporate finance.
Absolutely. It's foundational. We're not talking about, flashy derivatives or market timing.
No, we are cracking the code on the rules. The basic conventions that let you read, compare, and actually trust any financial statement from any company out there.
It's really the user manual for financial reports. People tend to think accounting is just, tedious math.
Right.
But what really defines it is a set of philosophical choices, a set of principles. And if you, the listener, get a handle on these, you get this immediate shortcut to understanding the intentions and, maybe more importantly, the limitations of the numbers you're seeing.
So our mission today is to really distill this down to 5 core pillars. The concepts that dictate how all this information gets collected, measured, and, presented.
Think of it as the bedrock. We're
Yep.
going to explore the constant tension between speed and accuracy, the rules we need for benchmarking.
Oh, that's a big one.
Huge. And then the history of financial prudence, how we decide what errors actually matter, and finally, the hidden mechanics that make sure all these different reports actually link up.
Okay, so let's lay out that roadmap. We're starting with the big trade-off, relevance versus reliability. Then we'll get into the rules for comparison, comparability, and consistency.
After that, conservatism, the historical bias, then materiality.
The doesn't matter test. And we'll finish up with how it all connects, articulation. Ready to dive in?
Let's do it. And we should start with what I call the fundamental conflict, this tension between relevance and reliability. It all really boils down to one question.
What's that?
Can financial information be perfect, timely, and precise all at the same time?
Well, when you put it like that, the answer is obviously no. But why is that trade-off so fundamental? As an investor, I want everything, and I want it, 5 minutes ago.
And that's the core tension right there. Relevance is all about being useful for a decision. To be relevant, information has to be fast, it has to be timely, and crucially, it has to be forward-looking. It needs to help you evaluate the past or, more importantly, forecast the future. If it's too late, it's useless.
So relevance is speed and predictive power.
Exactly. Now, contrast that with reliability. Reliability is all about trust. It's about verifiability. The information has to be accurate, sure, but it also has to be verifiable.
Meaning?
Meaning, if you gave the same data to a bunch of competent people, they'd all come to more or less the same conclusion.
That sounds slow. Like it involves a lot of checking and paper trails.
It is slow. Reliability demands careful, precise work, which takes time. So there it is, the trade-off. To be fast and relevant, you have to accept estimates, you have to accept uncertainty, which makes it less reliable.
And if you want it to be perfectly reliable.
And you take so much time verifying everything that the information becomes outdated. It's less relevant for the decision you have to make today.
So wait, if the trend is moving more toward relevance and away from that historical reliability, aren't we just admitting that financials are more speculative now? I mean, isn't that a little dangerous?
That is the big question in modern accounting. Historically, the standards were all about reliability. We were anchored to historical cost, what you paid for an asset 10 years ago, because that number is 100% verifiable.
But nobody cares what you paid for the land 10 years ago.
Exactly. Investors want to know what it's worth today and what it's going to produce tomorrow. The market is forcing this shift toward forward-looking relevance.
That's a huge philosophical change.
It is. Take something like goodwill. Company A buys Company B for a big premium. That premium gets recorded as goodwill on the balance sheet.
Okay.
Every year, Company A has to test if that goodwill has lost value, an impairment test.
And that's super relevant because if it's impaired, bam, it hits the income statement and crushes profit for that quarter.
Precisely. But that calculation is, it is incredibly complex. You're projecting future cash flows, picking discount rates, making all these assumptions about the economy 5-10 years from now. It's highly relevant, but the final number is just an estimate. It's inherently less reliable than, say, counting boxes in a warehouse.
So as users of these reports, we have to accept we're relying more and more on management's assumptions and less on hard historical fact. That totally changes the risk profile.
It changes what the financial statement is. It's less of a historical record and more of a forward-looking forecast. And forecasts, by their very nature, are uncertain.
Wow. Okay, that's a powerful way to think about the data we're getting. So let's move from the quality of the data to its usability. Once we have the numbers, we need them for benchmarking, which brings us to comparability and consistency.
Right, and these two are just foundational for any kind of fair analysis. We use them together, but they do different things. Comparability is about comparing financial info across different companies at the same point in time.
And this is why we need global standards like GAAP or IFRS. It's non-negotiable. If one company calculates revenue with method A and another with method Z, comparing them it's just worthless.
It's apples and oranges. Comparability is horizontal. It lets you put Coca-Cola's performance next to PepsiCo's, or see how one company stacks up against the industry average. It's the whole point of standardized reporting.
Okay, so consistency must be the vertical piece of that.
It is,
Yeah.
exactly. Consistency is a subset. It means a single company has to use the same accounting methods from one period to the next. The value isn't just in a single number, it's in the trend.
So if a company kept switching how it calculates inventory costs every single year, its profit trend would be completely meaningless, even if the business itself was stable.
Precisely. Consistency is what lets you track performance over time and make informed predictions. If a company suddenly reports way higher profits, the first question an analyst asks is, did the business get better or did they just change the math?
And this stops management from just gaming the system, from switching
Yeah.
methods to make the numbers look better in a given year.
It does. I mean, they can change methods, but only if the new one is genuinely better. And if they do, they have to disclose it and explain the impact. That disclosure is what keeps the comparison fair.
Right. That maintains the integrity.
Yeah.
Let's pivot now to something I find fascinating, this historically charged convention. Conservatism. People call it the prudence principle, but it almost sounds like it encourages bias.
That's a great way to put it because it absolutely introduces a deliberate bias. The old saying for conservatism is famous. When in doubt, recognize all losses immediately, but only recognize gains when they're certain.
So why? Why would accounting ever build in such a pessimistic rule? It seems to violate the whole idea of being neutral.
Because it was a rule designed for creditors, not for shareholders. Go back to an era where banks were the main people reading these statements. A bank's only real concern is downside risk.
Getting their money back.
Getting their money back, they don't get to participate in the huge upside if the company does great. So if a company systematically understates its assets and overstates its liabilities, it gives the lender a bigger margin of safety.
A bigger cushion. So it makes the company look a little weaker than it really is, which the bank is perfectly happy with.
Exactly. If the company looks better than it is and then fails, the bank loses. If it looks worse than it is but succeeds, the bank still gets paid back. Conservatism protected the lenders.
But that's a huge problem today with public markets and the need for accurate valuations. If a company is intentionally making itself look worse, it messes up the entire valuation process for investors.
It does. And that's the modern tension. Mindless conservatism undermines neutrality. So you see standard setters all over the world moving away from it as a formal principle. Modern investors need neutral, unbiased information for true valuation.
But you said it still serves a purpose. How does it manage to stick around if it's not official policy?
It survives as a check on human nature. Managers, entrepreneurs, they are naturally optimistic. They're incentivized to show the best possible picture.
Of course.
Conservatism acts as a counterweight. It forces them to justify that optimism, especially with those high relevance, low reliability estimates we were just talking about.
So it's less of a formal rule now and more of a necessary skepticism, a way to keep those rosy projections grounded in reality.
That's it, exactly. It's a constant reminder. Prove the good news before you report it, but report the bad news the second you even suspect it.
That makes perfect sense. Okay, from principles to practice, let's talk about the idea that some things just aren't worth the effort. This is materiality, the does it matter test.
And this is maybe the most nuanced one because there's no fixed dollar amount. An item is material if knowing about it would actually impact the decision of someone reading the financial statements.
So if a $500 billion company forgets to account for a $20 wastebasket, no investor on earth is going to change their buy or sell decision.
Correct. It's immaterial. And this concept is crucial for efficiency. For example, if you buy a big machine that'll last 10 years, you're supposed to capitalize it, put it on the balance sheet as an asset, and then depreciate it over those 10 years.
That sounds like a lot of work for a $10 trash can.
It is. So materiality gives you the shortcut. The trash can is immaterial, so you just expense it. Write it off immediately. It hits your profit today, but because the amount is so tiny, it doesn't matter. It doesn't mislead anyone. We take the easy way out.
And for auditors, this must be how they decide where to even begin looking.
Absolutely. Materiality defines the entire scope of an audit. They aren't looking for every single mistake in petty cash. They're looking for errors big enough, material enough to actually mislead an investor.
And we should clarify, it isn't just about the size, the dollar amount, is it? It's also about the nature of the item.
Oh, that is the essential point. Size is usually the first thing you look at. 5% of net income is a common rule of thumb, but it's informal. But the nature of an item can make it material no matter how small it is.
Can you give an example of that?
Sure. Let's say a CEO makes an unauthorized $5,000 payment to a company owned by his brother-in-law. For a huge corporation, $5,000 is nothing. It's totally immaterial in size.
Right.
But the nature of it, a related party transaction, potential fraud, a breakdown of internal controls, is highly material. Knowing about that breach of trust would absolutely affect a user's decision, even if the dollar amount is a rounding error.
So it's professional judgment at the end of the day, not just a simple calculation.
Exactly. It's all about context. A $1 million error could bankrupt a small company, but be completely immaterial to a giant one. Context is everything.
Okay, we've covered quality, comparison, prudence, and significance. For our last pillar, let's talk about the system that holds it all together: articulation.
Articulation is this beautiful concept that the three main financial statements, the balance sheet, income statement, and statement of cash flows, aren't separate documents. They're not just a random collection of reports.
They're connected.
They're mathematically intricately connected. They form one integrated, self-checking system. They have to fit together perfectly.
So which one is the anchor in that system?
The balance sheet is the anchor. It's a snapshot. It shows your assets, liabilities, and equity at a specific point in time, like midnight on December 31st. The other two statements describe the activity over a period, like the whole year, and they explain how the balance sheet accounts changed from the beginning of the year to the end.
Okay, so how does the income statement connect to it?
The income statement gives you your performance revenue minus expenses equals net income. That net income, minus any dividends you paid out, explains the exact change in your retained earnings account on the balance sheet. It has to tie out to the penny.
And the statement of cash flows takes care of the cash account.
Correct. The cash flow statement shows all the cash that came in and went out from operations, investing, and financing. The net result of all that activity perfectly explains the change in the cash account on the balance sheet from the beginning of the period to the end.
So articulation isn't just about making things look neat. It's a diagnostic tool.
That's the crucial takeaway. It's the primary way auditors spot major errors or even potential fraud. If the numbers don't articulate, if net income doesn't explain the change in retained earnings or the cash flow statement is off, then something is fundamentally broken in the accounting. The whole system has failed.
That brings us to the end of a really insightful deep dive. We've laid out that key trade-off, the constant pull between fast, forward-looking relevance and slow, verified reliability.
We hit the rules for fair benchmarking comparability across companies, consistency over time, and we looked at how that old bias of conservatism still hangs around to counter our natural optimism.
And we cover the importance of judgment with materiality, knowing what actually matters. And finally, the elegance of articulation, the system that makes sure the whole financial story actually holds together.
And understanding all of this, it takes you beyond just reading numbers on a page. You start to understand the design choices, the limitations, the intentions behind every single figure. You know what risks are baked into the estimates.
Which leads us to our final provocative thought for you, the listener. Since modern accounting is so clearly leaning toward fast, forward-looking relevance over the slow, verified reliability of the past, what does that imply about the certainty we should place on a company's valuation? Are you investing in a verified historical truth, or are you really investing in a set of meticulously calculated, management-driven assumptions about the future?
Something to think about next time you read an earnings report.
Always. Thank you for joining us for the deep dive.